Well, Dan, I've been warning about this for a long time. The baby boom peaked in their entire spending cycle back in 2007. And so we had the great crash and recession of 2008 into 2009. And the central banks just went haywire. I mean, they just started printing tons of money. They didn't let that recession do its work, okay, and work out the excesses and the zombie companies and the bad debts. So we're carrying all this into the future with endless stimulus. And then COVID hits and they go haywire even more. $10 trillion, Dan, fiscal and monetary combined, about half and half. $10 trillion in 2 years to stimulate an economy just because of COVID, which is a short-term challenge anyway. So now they have to tighten now. And what people don't realize, they've been keeping this economy going now for 13 years purely on stimulus. Because the baby boomers are done, and the millennials, which I project very clearly in the future, a boom for like maybe late 2024 to 37. Okay, but in between, we've got this weak fundamental economy driven by stimulus. And now they've gone so far, they have to tighten and work against themselves. And I think this tightening is not going to be taken well by the economy. And by early next year, we're going to see another wave of stocks down, just like we saw or more. I call it the first wave crash. We're in that rebounce, and we're just coming into the third wave now. We're just making new lows and a lot of stuff. So that's a bad sign. I think we have another big wave down into late this year, early next year. Bounce, and then we have another big wave down into late next year, early 2024. This will be what I've been saying, the crash of our lifetime. It won't be quite 29 to 32, but it'll be more like 29 to 32 than it was 74 to 75 or 2000 to 2002. And it'll be like, I call it 2008 downturn and recession times 1.5. That's my rule. This is going to be 50% worse. Stock's going to go down 86% instead of 57. And on and on and on. We're going to get 15% unemployment instead of 10 or 11. So that's what look at. Whatever you thought 2008 and 9 was for your business, your investments, this should be about 50% in other words, the direction you're going. And now we're in a bear market from my point of view. So the waves ought to be 5 waves up in a bull market, as we saw 87, 2000, 2000, that sort of thing, 2021. Now we're in a 5-wave sequence down. We saw the first wave bottom in June, okay? We've bounced since then, and now we're coming out of that bounce. We're in the third wave from my point of view, just breaking below the first wave in the NASDAQ and most of the major indices in the S&P. And this third wave should be at least as strong as the first one, and it should be stronger. It's likely to be 50 to 60% worse. So we could see the worst of this downturn into early next year. It took 5.5 months, that first wave, so it's probably going to take that or more for this one. First wave took down the NASDAQ 34%. This will probably take it down, after a bounce down 55 to 60. Now that Dan is when people are going to know, this is no longer a correction. The central banks actually lost control. See, all I've been waiting on, Dan, for years is the central banks to lose control, because all they've been doing is printing money. You don't solve any real problems with short-term cures, like just printing money out of thin air. You have to restructure, you got to cut back debts, you have to do real things businesses would do in a turnaround, same with the economy. So this has just been Pollyanna, and now it gets to the point where they overdid it. I think they have lost control. There's no way for the Fed. They can't turn around now and loosen aggressively after finally admit they have to tighten, and after they responded. They're stuck.
Yeah, I agree with you.
Turn around quickly, and I think by time they do turn around, this crash is going to go down enough that people will say, no. We thought that the central banks could control this. We thought the economy could go out. People are going to get diversify in different countries and different economic sectors. Tech and consumer discretionary, and Europe and US and East Asia, all this sort of stuff. In a downturn, everything, what we have to see, there is nothing, including the magical gold, that did not bubble. In fact, gold at the peak of its bubble not too long ago went up more than stocks did. So people saying buy gold is to say, David, that's one of the biggest bubbles, okay? So everything, financial assets have to reset. And then I'll give you the most important number in the world, Dan. $577 trillion going on, probably closer to 600 by now. That's all the financial assets in the world. And that normally is 2, at most 3 times GDP. It's like 6.5 times global GDP at 94 trillion. So this is a global bubble in everything. So bonds with any risk have to come down. Stocks anywhere in the world have to come down. Hey, they may down 50% in Australia with better demographics, and 86% here, and 92% in the tech stocks. That's my forecast, basically. Australian stock market, where I'm going next couple of weeks to lecture, down 59%, which will be the worst they've seen in decades, but it'll be better than almost anybody else. Real estate, it already went down 34%. We didn't even see that in the Great Depression because we didn't have a real estate bubble in roaring 20s. You couldn't borrow money easy enough to have a bubble in real estate. That was crazy. Now we do have a global everything real estate everywhere. So I'm seeing real estate going down, what did I say, 1.5, 50% instead of 34%. Now that is painful. It's one thing stocks go down, stocks can bounce back pretty quickly. And most people don't have most of their net worth in stock. Most people do have the majority or a big part of their net worth in their home.
It's all real estate.
People have vacation homes, and a lot of people have been speculating in real estate. This real estate crash, if it's 50%, and that's just going back to the 2012 lows. It's not going that far in history. We're not going back to 82 or 90 recession or anything. Just down to the recent lows. We came out of 2008-9, but real estate took much longer to turn around. We didn't come out of real estate till 2012. We're going to just go back to those lows. That's 50%. That's how big a real estate bubble. Real estate doubled since then. So that's going to be the most painful thing for most people. Their house goes down, and this time it doesn't go roaring back. I'm going to Australia and say, hey, your market's going to go down 50 to 59%. That's going to look very good. The UK and European market is going to go down more like ours. Maybe not quite as much. We had a bigger stock bubble than anybody, but real estate bubbled everywhere. Australia and New Zealand have an unbelievable real estate bubble. And the number one real estate bubble in the world is China. China's stock market, okay, yeah. But everybody owns homes. Poor people own sometimes 2 or 3 homes, and 1 or 2 of them sitting empty in China. So China is going to get hit the hardest by this. Australia by being next to them. The whole world's baby boom is turning down, except for Australia, New Zealand, and Norway and Sweden, a few small countries. So this is a back to reality now that the baby boom and all the stimulus has gone as far. We go back down to reality, and that just means stocks go back down to early 2009 lows, real estate 2011, average real estate 60 to 70%, and upscale ritzy real estate. So this is going to be the biggest shock we have seen in our lifetimes. Again, more like the early 30s, maybe not quite as extreme. That was just a naked crash. They didn't do anything to stop it. No stimulus, anything, no cushioning. And it'll be the biggest. Our kids will not see a crash this big. I think even when they grow up. Now we've had this is the second stock bubble. It's the second, in particular, tech bubble, with more extreme, and the second real estate bubble. We've never had double bubbles in any of this. Real estate never bubbles, crashes, and bubbles again. So the first tech bubble peaked in May of 2000. Okay, guess what drove those? It was Amazon and the new .coms. Only from 97, late, even in that surge, they came in the last 3 years and really bubbled it up, and they crashed the most. Okay, so the NASDAQ went down 58%. Amazon went down 95%. The .com internet index went down 94%. So that's what I see. This time it is the cryptocurrencies. Now they're not part of the NASDAQ this time, except for a few, Coinbase or a few people got on or something. So crypto is the bubble of the bubbles. It is the most extreme. Crypto's gone up. Bitcoin's gone up the most. Bitcoin, just to go back. Now listen to this. I said, 2012 for real estate, 2009 for stock, just to go back to its late 2018 lows after the last crash. It's going to get a 95, 96%, just like Amazon and .com. So that crypto, Bitcoin may actually physically bottom on the next crash down ahead of stock. That'll be the third wave down with another 5th wave to follow. I think that might be the final bottom in Bitcoin, but then it goes more sideways and retests that bottom. You may see the worst in Bitcoin by early next year. And again, my prediction, just back to the 2018 lows, but that's $3,233 from 69,000. What is that? Guess what? Just like Amazon and the .com, 95%.
So you're thinking
the biggest bubble, the biggest burst. So even at 20,000 next year in stocks as early as late next year. Now this all could go a little longer. I have on the outside mid to late 2024 for bottoming stocks. Because again, the central banks have pushed this out and out. Okay, natural cycles, we would be bottoming earlier. So the earliest for the stock market is late 2023. I'd say the earliest for Bitcoin is maybe early next year. And even after that, I don't think it's going to make much progress. Stocks don't come out of this till sometime well into 2024, and Bitcoin really won't come out of it strongly until just before that too. Normally, Bitcoin leads stocks by about 7 weeks. So I'm just saying the Bitcoin though did bubble the most, gets hit the worst, so it may actually technically bottom several months ahead of stocks, but it doesn't mean it's going to come running out of it.
So hold on, basically, just to find something.
Well, I'm not holding on to anything. Again, you hold through normal 10, 20% stock corrections. We've gotten them all through the boom, even occasionally a 50% crash, like we had, 40% in 87 or 50% in the early 2000s. But the markets come back to new highs quickly. The markets are not coming back to new highs for two reasons. The millennial doesn't even start their next boom until sometime in 2024, and will take 15 years to build that. And the central banks, after more and more stimulus, for this thing to fall apart just 2 years after 10 trillion, by the way, is 46% of GDP. You imagine explaining to your grandkids, well, our central bankers thought we should spend 46% of our GDP just to keep a tired boom going another couple years. How does that sound, kids? Would you reelect those guys? Huh? Yellen, and Powell,
Sure.
and Bernanke, and all these guys, none of them ever had sex or run a business. I mean, I hate to say it, but they're not even in the business world. Janet Yellen looks like she came out of a nunnery. I hate to say it, but it's true. Where'd she get that haircut? I mean, these are the people that have been feeding this bubble the most. Everybody feeds it because we all a bubble is something for nothing. Stocks and real estate normally goes up with inflation rate. What's that today? 1 to 2%. Well, it goes up 10 to 20% a year recently. We're getting a free lunch. This lunch gets taken back when the central banks lose control or the bubble gets so stretched that it just blows anyway. A lot of the bubbles in history, including the 2000 bubble in tech stocks, the recession came a year later. It wasn't the economy or recession that killed the bubble. The bubble killed the bubble. Stocks just got crazy and they finally fell apart.
Yeah,
and then
I'm
when
optimistic
the smart money
about
starts
buying the
selling
best
and
stuff, I
everything
will
else. Actually, you get Bitcoin in that 3 to 4 or 5,000 range, I will buy Bitcoin. It may be an invisible coin, but it's got complex technology behind it. And it is blockchain. Somebody at my own conference, a speaker, Mark Youssef, explains that it's the digitization of all financial assets and money. The biggest number I threw out earlier, 577 trillion in global financial assets, and it's probably already, that was a couple years ago, last time I could tag that and put it all together. It's going to be 600 trillion by the time this bubble's bursting. That's the biggest number in the world. If you can digitize that and make that much more efficient and easy to buy and sell and measure and stuff, that's the next wave.